Hi there. Just a reminder to everyone on the lunchtime round tables, if they can please finish their discussions now. We'll be starting the next session in 2 minutes' time. Thank you. Okay, I think we can go and start this afternoon's session. Just before we do, I'd just like to make one or two small administrative announcements. For those of you that enjoyed the New York show today, our next show will take place in Toronto on the 2nd to 4th of October. Details are in the event guide, and we'll also be sending the details to you after the event. Also, at the end of this afternoon's sessions, there'll be a drinks reception taking place in the exhibition area next door. It gives me great pleasure for this afternoon's session to organise them in partnership with Kitco. And without further ado, I'd like to introduce the Editor-in-Chief of Kitco News, Daniela Cambone. Please give a warm welcome to Daniela.
Thank you, everyone. Welcome. As Andrew mentioned, I'm the Editor-in-Chief for Kitco News, and we've partnered with Minds and Money to bring you this afternoon session dedicated to something I believe everyone in the room is very interested to learn more about, the precious metal gold. When we were fleshing out, thinking of the panels, we really based it on topics that we hear often from the audience. And of course, the number one question is, where is gold headed? And as we know, no one really has that crystal ball, but we can try and gauge sentiment, and that's what we're hoping to do with this afternoon session. But first, a very timely presentation we're going to start with today. I say timely because I'm just reading that the DOJ is now probing Goldman Sachs for rigging treasury auctions. And well, we won't be speaking about that today. We'll be looking at manipulation and price fixing in gold and silver. It seems to be a never-ending debate, but we've brought to you a definitive expert. I believe she's one of the greatest minds on this in the world, Dr. Rosa Brantes-Metz. She's the managing director for the Global Economics Group based here in New York City. She's also a professor at the Stern School of Business in NYU, and she specializes in conspiracies, manipulations, and fraud matters, and her work has assisted in the uncovering of some of the largest financial rigging stories of the last decade. So she will have a lot of insights for us this afternoon. So without further ado, I'd like to welcome Dr. Rosa Brantes-Metz to the stage. And we will open up the session to questions from the audience later.
Good afternoon, everyone. I would like to start by thanking for the invitation to talk about one of my favorite topics, which is collusion and manipulation. As Daniela was saying, this is what I have specialized in for the last 10 years, and in particular, not only, but particularly in financial and commodity markets. So my presentation will be fairly short, but hopefully I'll give you a sense of some of the patterns that I found initially striking in gold. And of course, this is just the beginning. The cases and the investigations are ongoing. And how I came to decide that this was something that I wanted to look at. So before we start, let me let you know that anything I say reflects my own views and not necessarily the views of those with whom I'm associated, namely any of my clients. And all the information here is public, either in public sources or directly in the U.S. class action lawsuit currently pending here in New York. So in 2013, as I was part of the discussions and advising authorities on how to reform financial benchmarks, namely due to the LIBOR scandal, I came to learn how gold and silver were set. Of course, platinum and palladium are similar as well. Those are markets that I've also studied. But today I'm going to talk about gold. And as an antitrust economist, bells rang. I thought this is not a type of collaboration among competitors that would normally be allowed to proceed in almost any jurisdiction. And let me explain to you how that's the case. The Department of Justice, the FTC, the European Commission have guidelines on the types of collaborations among competitors that are allowed in terms of those who would be per se illegal versus those who may be just so concerning that, there's the potential that anti-competitive behavior will happen, and therefore we will not allow them. I authored similar guidelines for Central and South American countries, and when I learned how the gold fixing was set, I thought this was a setting when I had thought in 2008 that I would never see anything potentially more defective than the LIBOR setting. I was wrong when I learned about gold. So gold was set. It is different now, coming out of all of these litigations and investigation. Gold was set twice a day, AM and PM fixings in London, and they were set by 5 banks who got into eventually a call in 2004. Prior used to be in-person meeting, and they chatted about the price of gold, of course, through an auction, but they collected their orders from their clients and their own and entered into an auction which normally lasted just a few minutes, and the price of gold was determined. Now, the chair of the group was one of the banks. There was no recording typically of any of these calls. It was all non-disclosed to the market. And you have a set of competitors who are large market participants, who are true competitors in a market, chatting privately about what the price of gold will be, having private information about it ahead of the rest of the market, and determining the price of gold itself without any disclosure to the rest of the market. All of these was extremely concerning. Now, this is not a proof of rigging. It just means that the ability to rig is there, and it is pretty big. So when you build a case like this, you think about the ability to move prices, the incentive to move prices, and then from somebody like me, when I'm not working with the U.S. government, which I have a few times, I have to think about what is publicly available to determine whether there's a high likelihood that something happened or not. And normally for me, that means empirical data. So when I thought in 2013, I can't believe that gold is set this way, I thought, all right, these look suspicious, highly conducive to rigging. Let me look at the data. And so when I looked at the data, I wondered, why do these prices go down the vast majority of the days during these fixings? As you know, I'm an interest economist, but my background is financial markets. This level of predictability is highly indicative of a highly efficient market if this were a free market at that moment in time. But at that moment in time, this is not a free market. There's a small group in those fixings that is setting the price. And the price goes pretty much one direction. And in late 2013, I then wrote an op-ed in Bloomberg explaining that I thought we should reform gold and silver fixings, presenting some of this evidence. Here I have average prices for futures and spot for gold normalized so that I can compare them across, average them out across years. And we have two vertical bars. So these are average prices on a daily basis, the average price per minute on each day, on per day, average out over all of those years. And we see that prices on average drop drastically at the AM and the PM fixing. And I have studied dozens of markets. I could not understand how this could be happening normally. Because in a free market, if there is this high predictability of price movements, somebody takes advantage of it, and through arbitrage opportunities, these effects disappear. But again, during the PM fixing and the AM fixing, the market is not freely operating. The price is being set by a small group with particular positions tied and instruments tied to the PM fixing. So I kept conducting some research, and in late February, Bloomberg covered some of that research in which I presented additional patterns that I thought were consistent with market rigging. And 5 days later, the first lawsuit was filed, and I believe there were 30 or 40 lawsuits in a month or two. And meanwhile, investigations did start, and last year, Deutsche Bank has settled with plaintiffs in the United States. So the case is ongoing, the investigations are ongoing, but I will show you a few of the more general patterns that I found in this market and similarly in other markets I have studied, namely U.S. Treasury auctions that are in the news right now, a case I've been working on for a couple of years, that certain pricing patterns just do not add up. So gold prices were manipulated if they were artificial, if they were not reflective of market conditions, of market fundamentals. And if there is collusion in order to manipulate prices, that means there is coordination among two or more market players, then here in the US, that's a criminal offense. And so it gets much more serious. So the previous chart, what I showed was the following. I showed that on average prices drop during the fixing, but we know that averages sometimes hide a lot of things. So I asked myself, well, how often do prices actually drop during the PM fixing? So each of these bars represents 1 year from 2001 through 2013, and the height of each bar is 100%. In red, we have the percentage of days in that year for which prices went down during the PM fixing call. And as you can see, it is the vast majority of the days, less in 2013 when potentially the conduct has, at least empirically, started to abate. Now, for those of you who have financial background, Professor Gene Fama won the Nobel Prize in Economics a few years ago, and some of his theories that reform securities, financial theory in general, and for example, securities law, deal with unpredictability in prices. In an efficient market, if you cannot predict the price movement from 1 minute to the next, it's got to be about 50%, because if it isn't, somebody realizes that pattern, jumps in, takes advantage of it, and the anomaly disappears. So I just couldn't understand how this was happening. And doing this research, I realized that lots of other people had noticed that the prices were going down. But I don't think I had ever seen put together that really what we thought was going on here was potentially collusive conduct throughout the fixing. Let me give you a further example of how tremendously unusual this pattern of prices going down during the fixing is. The first chart I show, usually the fixing takes a couple of minutes, sometimes 5 minutes. So what I show here is that in the first line, for gold spot prices, prices dropped on average 70% of the time. But if I look into S&P 500, in a very narrow time window, and highly liquid time of the day, I see that over many years, prices drop 50.4%. And even for gold spot, 1 hour before and 1 hour after the fixing, prices drop 49.7% and 50.1%. And I also see that US Treasuries prices drop in a narrow window of time, highly liquid one, 48.6%. And down, we can see many more examples. The pattern in gold fixing is highly unlikely to be due to a legitimate factor. I think, in my mind, the question was not whether rigging occurred. The question was what really was the kind of rigging that occurred. So after all of this got started, I'll take questions at the end. Thank you. I'm sorry? So the PM fixing happens, is it 3 p.m. London time? It was 3 p.m. London time. So after all of this happened and all of these lawsuits got started and all of these investigations around the world, Deutsche Bank settled with plaintiffs here in the United States, and the amended complaint by the leading law firms contains some communications that are illustrative of coordination. In here, we have a UBS trader saying, okay, when gold pops 1430, we whack it. You sell 50K, I sell 20K, then we double that up and produce our own liquidity too. That should be enough to cap it on a holiday. And Deutsche Bank trader says, haha, yeah, lol. So to my knowledge, these are the first communications that have been made public and contained in the complaint that support what I had said 3 years earlier, that I believed what I was seeing was due to collusion and coordination. Of course, all of this is ongoing, and we'll see what other kind of evidence comes out. So why should we care about all of these? Well, I care because I love working on these cases. I am, surprising you might think, I am a believer in markets. I am a believer in as free markets as possible. I used to be even stronger on free markets. I'm a University of Chicago economist, but I've seen too much rigging, and that happens primarily when a few large market players control the entire market and several chains of the market. And so we do need some sort of some smart regulation to control and break certain channels apart. And then markets can be a whole lot freer. But why should we care? Well, manipulation distorts prices. If the manipulator puts a fake price out, everybody else in the market looks at that price and believes that that price is real, and therefore affects their own expectation of what prices will be, and therefore reinforces the effect of the manipulation. We all potentially lose with a manipulated market, even more if the market was systematically and sustainably manipulated as gold may have been. So who was affected by the conduct? Potentially anybody who traded gold at least since 2004 or even longer. And we need to be able to trust markets. For me, that's, of course, the laws may have been broken, but I think at the end of the day, it is a matter of trust. We need to believe what we see is real, is reflective of market fundamentals. Unfortunately, starting with LIBOR and foreign exchange and potentially U.S. treasuries and swaps and lots more potentially coming, we have seen that markets have systematically been abused. And all of these, with the exception of treasuries, concentrated on rigging related to financial benchmarks and the highly defective structures that these benchmarks were set on that made it so easy to move prices. And of course, the incentive was there because there were hundreds of billions or trillions of dollars benchmarked against these numbers. So it was easy to move, nobody was watching, and the gain was massive. What's the chance that it was rigged? So gold has been reformed. It is now administered by an independent party, ICE Benchmark, which all of that is very good news. We need an independent administrator to ensure that safeguards are in place to the extent possible and minimize the likelihood of rigging. But I wrote in an op-ed in Financial Times a year ago, I think that things need to go deeper than that. Many of you, certainly I have, seen very many of the communications, like much worse than the one I showed you even earlier, among traders attempting or actually manipulating a variety of markets. Much of that came out on LIBOR, on foreign exchange, etc. Do you think that in the future they're going to be leaving that direct evidence behind? I don't. They have learned their lesson. If regulators think that they're going to, next time around, file all of this paper trail, I think they're wrong. So we need to first reform structures that are defective. Clearly, the way gold was set was highly defective and conducive to abuse. We have to minimize the likelihood of abuse by having structures that are more immune. Nothing is 100% immune to manipulation, but that are better set. And then we need to screen markets regularly in order to detect potential anomalous patterns which may be indicative of abuse. And I think that's the way things, that's the way that policy with respect to these types of cases should move in the future. So all of this is developing. These cases last forever. There are investigations around the world. As I mentioned earlier, Deutsche Bank has settled with plaintiffs, and I think we're still going to be waiting to see what's going to happen to these and what kind of evidence comes out for the next several years. Well, hopefully the gold reform that was already put in place helped minimize this kind of, potentially this kind of conduct in the future. Thank you. I'll take some questions now.
Why do you think Deutsche Bank was the first, hopefully the first, to come to the table in the way they did?
That is, I'm sorry, it's not a question that I can answer. I cannot discuss anything related directly to the banks. Obviously, I'm involved in all of these cases. So I'm not going to be able to answer any questions directly related to any particular bank.
Is the paper market on the COMEX being rigged to affect the physical market?
I'm sorry, I can't hear.
Is the paper market on the COMEX being rigged to affect the physical market?
Well, I don't know. I can say that in terms of rigging in metals, I have been taking a look at all areas, and that includes what you are mentioning. But I don't yet know whether it was or not.
To follow up that question, it is an open secret that many times the Goldman Sachs and JP Morgan's all of a sudden within a matter of few minutes at 3 o'clock in the morning or 8 o'clock in the morning, New York time, dump millions of ounces in gold and also silver. And it happens within a matter of few minutes. And that is not something that is secret, because anybody who is watching the open interest and the
Are you talking about high-frequency trading?
No, I'm talking about COMEX, gold, and silver.
Right, but again, as I said, I'm not going to be commenting on anything that may or may not be ongoing on COMEX.
Yes, if I get it right, the rigging is consistently on the downside. Why is that the case?
Well, it does not necessarily mean that there's only rigging when prices go down. It could have been rigging when prices go up. They just went up by less than they should have been. But the complaint puts forward the reasons why, that as much as it is publicly available in terms of positions, banks are net short of a variety of assets. Namely, the complaint talks about futures, but there's also, I believe the complaint also talks about ETFs, and therefore they have an incentive to drive prices down. Now, that's what's being alleged. Of course, all of these will be discussed under and uncovered or not under discovery that the case is taking right now. I don't know why they're shorting. In some of the cases, they have certain privileges, for example, in ETFs, in selling particular types of shares of ETFs, and they have a particular privilege, and they attempt to sell them at high prices, and these tend to be benchmarked against the PM fixing, and then they go buy them at the PM fixing at lower prices. Now, I do not attempt to have all of the answers. I'm just explaining what is alleged in the complaint. Why they're net short, I don't know. What I know is that in 2013, when the patents abated, they were net long. That coincided with prices not dropping so much. So none of this is a proof, as at this stage, is all a confluence of factors, of different things pointing to the likelihood of abuse that, under the court view, makes it plausible for that rigging to have happened and therefore let a complaint pass.
Yeah, thank you for your clear presentation and good works. And are you familiar with an organization called GATA?
Yes.
GATA claims that it's not only bullion bank manipulation, but also government manipulation. Could you please comment on that?
I have not looked into government manipulation. My work has focused on the fixing, and the government was not involved in the fixing. So I am not discussing what I haven't looked at. I'm not sure that that's pretty much down below my list. I'm interested in the COMEX situation. I'm interested in high-frequency trading. I'm interested in a lot of other aspects of gold way before I were to get to whether the government manipulated gold or not.
The Federal Reserve Bank sells a lot. I noticed every time, over the years, I've noticed every time there's a rally in gold, the Federal Reserve Bank sells a lot of gold to drive the price down. Have you found that?
I have not studied that in particular, no.
Yeah,
again, I have been focusing on the fixing.
Yeah, every time there's a rally, maybe the European central banks do it too. Every time we have a good rally going in gold, they sell a lot of gold and they drive the price down. You know, I don't mean to repeat myself, but I think it needs to be stressed, you know. I think that's what's going on.
It may be.
Well, Wall Street hates gold. The Wall Street firms, you know, the investment firms on Wall Street, they hate gold. You know, it's because it's like a struggle. You know, I mean, every time the idea is every time the stock market goes down, gold goes up, or if gold goes up, the stock market goes down.
Well, commodities do tend to vary inversely to asset prices because they serve in many ways as insurance mechanisms. So they do tend to have somehow of a negative correlation. I don't know if there's any additional manipulation on top of that, but that's an empirical fact.
I think we can allow one or two more questions from the audience. Okay, this gentleman here.
Aram Fuchs, Fertilemine Capital. One, I want to just stress that the first piece of email archive data that was used to impact a Wall Street-led conspiracy was Henry Blodgett in 2000. So the guys are doing it still in 2013. So I think we might get a few more email-enabled discoveries. I don't think they learn from other scandals.
So the patterns have been there for a long time. That is correct. And I've even found papers that show these patterns in the 80s. But they have gotten a whole lot worse since 2004. And in 2004, there were particular events, namely, apparently the meeting passed from in-person to a call meeting, which somehow may have facilitated the trading simultaneously to the call, so each one being on their computer and being trading as they learn immediately that there's either excess demand or excess supply, and we know which way prices are going. Or also, and maybe even more likely, the fact that there was an explosive growth of derivatives in the ETFs, and so many of them benchmarked against the PM fixing. So the intensity of these price changes became many times larger since 2004 and started increasing drastically.
Right. My point was, though, I think you will find some more juicy discovery items in the email because these guys just don't learn. They can't help themselves.
I think now they will learn. I'm not even in general talking about gold because this is still all ongoing. But again, I don't think these kinds of messages are going to be left anymore.
Okay. Now, my question is, so your process is usually to look at a control that's like a free market, and you look at that as the free market, and then you look at your target and you figure out how different the behavior is of that is compared to the control. Is that basically it?
Well, when you look into price anomalies, if price is the target of the manipulation, you do have to have a prior of what should prices look like, so you can compare against the prices that you actually see and realize this looks odd. You need to have a benchmark. Now, that benchmark could be many different things. It could be a comparable market at the same moment in time. It could be the same market prior or the same market much later. It could be the exact same market an hour before, an hour later. I showed how gold behaves so differently before and after the PM fixing. So you need to have a comparable as closely as possible. But then it's also, if you run very many approaches and they all point to an outlier, and we all know working with data that an outlier will exist, but you then start thinking this is a whole lot more likely that there's something here. But as an economist, I don't look at this as just an empirical question. I think you have to have the structure in mind, because first, you know, if there are thousands of competitors setting prices at that time, the likelihood that one of them or two or five are going to be able to influence prices is very small. So you need to have the microstructure of the market in mind to try and understand whether it is possible for anybody to influence these prices, and then whether there would be any incentive to do so.
Okay, I think that can we have a round of applause for Rosa's presentation? Thank you very much.
Thank you.
And now I'd like to hand the floor back over to Daniela. Thank you.
Thank you again, Rosa. We're going to start with our mining spotlights now, and we have Dwayne Parnham, President and CEO of Broadway Gold Mining, to talk about a legendary mining region still rich in copper and gold. Dwayne has over 30 years of experience in the mining and hydrocarbon industries, and he has spent his career developing and founding several resource-focused companies. So, welcome Dwayne to the stage.
Good afternoon, everyone, and thank you for attending the Broadway Gold presentation. This is the first of New York, so we're happy to be here, and hopefully we can highlight this very exciting project that we're engaged in currently. I titled this presentation "Legendary Mining Region." Hopefully you'll see in the next few slides why I think so, and then hopefully we can relate Broadway into summing it up as to why there's still a lot of riches left in this region. I will likely be making some forward-looking statements, so please, if you want to read that, I'm not going to, but we'll pass this one on. So the region that we're working in is outside of Butte, Montana. Butte, Montana, as many of the Americans here know, it's been classified as the richest hill on earth. Good reason for that, and a lot of precious, semi-precious metals have been mined in this region over many, many years. And in fact, the amount of copper that was produced here at one point was about 47% of copper produced in USA between 1880 and 2013 at a gross value, metal value of roughly $102 billion. That number could change based on commodity prices, but it's a good estimation. And it's believed that there's still in the epicenter of Butte area about $529 billion of undeveloped metal still yet to be brought out and sold. As far as what we're doing at Broadway, we're located in an area of Butte 45 minutes from this $529 billion epicenter. We're in good company. The Montana Resources that now own the Butte open pit mine, still in operation. And we're not too far away from Barrick Gold, who's mining from the Golden Sunlight mine. And they are, for those that are Montana environmentalists, Barrick has grandfathered in cyanide, so they're actually processing with one of the nasty chemicals that are not allowed in the state at this point. But Madison is located 45 minutes just outside of Butte. I can't help but bring up the politics because I think it's such a game changer for mining today. And being a U.S.-based explorer, I think it's worthy to note that this America First, this deregulation of what's going on in the states, and buy American, hire American. But I'm more particularly excited about the $1 trillion that is proposed to be spent in infrastructure, and with this kind of expenditure in the U.S., one can't help to believe that the price of copper is going up. Copper is up already about 28% year over year. Projections are showing that it's going to be much higher in the very near future, and there's for good reason for that. I got to also mention gold because we're a copper gold explorer, that also this huge stimulus has to have a positive effect on gold. Primarily because it's an inflationary environment if this really takes hold. And if you don't believe any of that, then geopolitical conditions could take hold and gold will do well on its own. The value creation model that I'm particularly used to, components of four key ingredients: opportunity, asset, strategy, and execution. As far as the opportunity, I believe, again, this is an early entry into what we're calling the next commodity super cycle. So, the workings and going on at Broadway fits in that very well. I also believe that being my third cycle in commodities and being a startup entrepreneur, we're finding a lack of quality projects in the industry today. So that's mostly due to the fact that senior mining companies and the mid-tiers are spending less and less money on exploration and leaving that task to guys like myself. And the third component in the opportunity is I believe that there's going to be a period of M&A activity where those that looked at other favorable jurisdictions will start to realize that the U.S. will now be classified as one of those favorable jurisdictions again because of those political reasons I mentioned earlier. Looking at from the asset point of view, you know, we look at undervalued assets. We want to be in, again, these friendly mining jurisdictions. We prefer assets that are at their advanced stage of exploration, meaning that others have spent considerable money either on infrastructure, geology, drilling, all these types of things. And grade is always important when we look at projects because grade can overcome a lot of problems within the mining regions. As far as the strategy is concerned, this is a strategy I've employed with a lot of projects that I've run, and that is we would find these assets, acquire them, and then we apply our managerial, our technical, and our financial expertise to upgrade them, and then de-risk the project in a way that you would either build to get it to a mine build finance stage, or we would look at M&A. That de-risking process, the same on either path you take. And of course, you know, the final one is to execute, and that's deliver on your strategy, and that means giving you know, sound returns to the shareholders. We've got a small but working board at Broadway. This is a new company. It was listed in October 2016. I'm particularly pleased to be working with this board. We're all dedicated and have qualities and attributes in our own and add value in our own way. And we also been fortunate enough in the area of Montana where we're working to be associated with Montana Tech, and we're hiring a lot of good quality geologists coming out of the program right now, and they're providing an impeccable contribution to the project. We hire a lot of local contractors, so we keep things local, and from time to time we obviously have to hire from outside, but we bring those consultants in on an as-need basis. So Steve Hansen, who's also here, he's the chairman of Broadway, myself. I've kind of put together this little startup slide because I think it's important to show what our history is, because really, as Rick Rule mentioned earlier today, you know, you're really betting on the jockey, and you know, this gives a bit of a history. And I should also quote Robert Freeland. I love using one of his lines, and he always comes out and says, you know, there's no smart people in mining. And, you know, you go, well, why is that, Robert? Well, he says, if we were smart, we'd be in the tech industry and we'd build an app and, you know, we'd make billions of dollars. But somehow I managed to survive this. I don't know if I'm smart or just persistent. But, again, this is my third cycle, and a number of the companies that I've started in maturity, you know, range between 250 to almost 900 million in market caps. And Steve, who's also been involved in a lot of these startup companies, had a lot more M&A success than mine, my biggest one being HRT. And, you know, between us, we've brought about $2 billion in capital to our shareholders. And I think that brings a lot to what we're doing here at Broadway. Like I said, Broadway is a new company. We're listing in October 2016. It's a TSXV primary listing. We are listed here in the OTC BQ and also in Frankfurt. We've got a small float. It's management owning a high percentage of the float. Myself is probably the single largest shareholder of just under 12%. This project is located in Silver Star, just 45 minutes from Butte. It's fully permitted for drilling, for extraction. Extraction meaning bulk sampling. It's not permitted for mining. And the main reason for that is just we don't have the economic studies done to date. There's been some historic production there. It's been small scale for the most part, but what's important here is very high grade gold and copper have been extracted from the property. These, you know, copper values up to 30%, gold values in the ounces per ton. And it through the workings over the years, it's also provided us with good infrastructure. We have power to the site. We have roads. And what's particular, I don't know if any of you guys have worked in remote parts of different countries and stuff. Myself, I've been in Africa, but what's really cool here is you can actually drive your pickup truck and go to Home Depot and buy a tool. This is the large claim area we have. It's about 1,800 acres in total. In the green, you can see where the old Madison mine workings are, and in the circle part, you can see where the extent of our drilling has been. There are other patented claims that we do not own. Those are in the lighter gray areas. for the most part, these are staked claims with a few patents that have a small underlying royalty. This is a kind of a blow-up of the original 450-acre property in size, where we've done some simplified geology. What's really unique and what's really cool and attracting our attention right now is the geophysics is showing us some very unique new areas to look for deep copper porphyries and some other massive sulfide areas. And if you can see these east-west south parallel zones and faults, then those are the really good hunting ground for new deposits. We've done a bunch of surface sampling, and the surface samples are showing really high-grade gold in areas, and this has helped pointing us to other areas that we should be doing further exploration. There's a little bit of copper in there. This is basically a plan view of our current drill program. We've been stepping out roughly in about 200 meters to the west, and we've been focusing on one deposit type within the geological envelope there. And then there we've announced some very good holes to the public, and these are very broad, 100 to 200 foot wide sections of copper, 1%. These would be open pittable if one was to go in and put a resource together today. You can see these are just big, broad, high-grade copper intercepts that we're seeing. In one case in 1707, we also started getting a bit of gold. And a little bit later in this presentation, I'll show you the different deposit types. As of today, what's been really exciting, we announced an extremely high-grade gold intercept from underground. We've drilled 7 holes to date, and the first hole that we put in for rush assay, returned 99 feet of 24.5 grams. That's like 30 meters of 24.5 grams for the metric, and 99 feet of 0.7 ounce per ton. But within that section, we've had some extremely high-grade intervals, taking us up between 2, 4, and 6 ounce per ton. 2 minutes. Sorry? I'm over 2 minutes, so I should stop talking immediately? Okay, so we'll get on with this. We're almost done. So anyhow, here's a long section where we're showing that the underground massive sulfide section we just drilled projects, and it's open in depth and it's widening. Quickly here, our new geophysical targets. So we've got mesolim mass that we've done on the massive sulfides. It's pointing again to another target at depth. We're looking at these deep copper porphyry targets. And anybody that knows this geology, these are company makers if we can hit one of those, and new massive sulfide bodies. I'm going to quickly go through this. We're fortunate enough in this property to have 4 deposit types. I won't go in detail on each one because I'm getting cut off, but open pit, high-grade copper, massive sulfide, high-grade underground, and copper porphyries, which are basically company makers. We've been very active, very aggressive exploration. We're delivering a lot of results to date, and you're going to see a lot more results from us in the very near future. And then in closing here, basically we've got a project that we believe will be a winner for us. We're going to deliver a maiden resource and de-risk this project for some form of M&A activity that we're all used to. And I wish to say that we just want a very small piece of that $529 billion. Thank you.
All right, we're ready to explore Canada's highest grade gold district now with Joe Campbell, CEO of Terex Minerals. Just quickly on Joe, he's a professional geologist with over 36 years of experience, and he introduced Agnico to one of its largest gold deposits. So, Joe Campbell, welcome.
Okay, I'm glad to see I'm back up to 10 minutes again, so we'll try to head right into this. it's a fairly bold statement to say we're exploring Canada's highest grade gold district, but that's based on the fact that the two largest mines in the camp, Con and Giant, produced at 16 grams per ton through their life of mine. And the next largest deposit, the Discovery, produced 1 million ounces at an ounce per ton. Cautionary statement. I've got 10 minutes, so please read quickly. For you people who are familiar with the Canadian gold in the Archean, most of you would be familiar with Val d'Or, the Timmins camp, Kirkland Lake. The Yellowknife camp that we're working in is identical. It's the same rocks, it's the same age of rocks, it's the same types of structures that host the gold. So for a Canadian, this is pretty ordinary exploration. We're not inventing anything new. And this is a camp that was established in the 1930s and has been active up until the 2005 with active mining. We now have a property that covers 418 square kilometers, and we own that property 100%, and I'll show you that property with some maps. Just on the management side, I've been in the business, as I said, about 36 years. I ran the last major project I worked on was I was the project manager for the Meliadine project in Nunavut. That is now owned by Agnico Eagle, and they'll be bringing that into production in 2019. I think their last ore resource and reserve numbers had them up around 10 million ounces for that camp. Stu Rogers is the president. He's got about 25 years as a founder, director, and a senior officer of companies. Mark Gallman is our CFO. And Alan Sexton, our VP, is a very important person, especially to me. He was my right-hand man at the Meliadine project when we managed that project for 7 years to get that one off the ground. That's just a stock chart there. We have about 100 million shares out. I believe we're sitting in around 57 or 58 cents today for our stock price. And we have a little under $5 million still left in the bank. And we just completed a 15,000 meter drill program, and we still have that money available to us. So this is really the money shot for the camp or for the property. So everything that's outlined in blue here belongs to TerraX. Down in the near the lower part of the drawing, you see Con Mine. Con Mine produced 6 million ounces. Above that, you see Giant Mine. Giant produced 8 million ounces. We've managed over the last 3 years to gather up all of the property north and south of the Con Mine. It's on strike from the main structures, so we're in elephant country here, and we're not just staking up ground for the sake of saying we have a great big property. The bay that you see in the middle of this drawing is Yellowknife Bay, and that's where the major break in the camp is. And if you're within a couple of kilometers of that major break, you're on the right geology to find deposits. So we've covered the most prospective geology, and we know now that certainly on the North Belt property, we're in one major mineralized system. All of the zones that we found occur within one deformation zone. So this is really a rare opportunity. You have a small junior company who has acquired 100% interest in a major mining camp in Canada. And this is not a postage stamp. We've covered all of the most prospective ground outside of the two past producing mines. So that covers off why we're there geologically. Another good reason why we go into these areas, and most of my career over 36 years has been at the back end of mining. So I've done underground open pit mining, I've done economic studies, project management of advanced projects or reserves. One thing that always comes of great interest is the fact that you have good infrastructure. This map shows near the bottom the street map of Yellowknife. It's the capital of the Northwest Territories. It's a mining town, so all of our services, our drill contractors, our suppliers, all come straight out of the city. We don't have any camps. We live in the city. Our core facility is in the city. As the previous gentleman stated, you can go to the local hardware store and pick up your gear. So there's no camps, there's no airstrips. All of those expensive logistic issues are not part of this project. And there's a little bit of icing on the cake right at the top of that divot in our property in the north. There's a hydro dam, the Bluefish Hydro, which was just opened up in 2013. So we have excellent infrastructure and we have excellent service people available at our doorstep. So that's all fine and good. Is the property any good? Well, I've just put some highlights in here of our discoveries since we've been there, and I'll just rattle them off. Christorum, it actually was discovered before we picked the property up in 2013. It now has 300 drill holes into it. Our best intersection was 5 meters of 62.9 grams. That deposit is running at about a 7.5 gram average, and it's our most mature play. But we haven't drilled it since 2015. A shear 21 meters of 3 grams. The A-Bear Brent, and you can see these deposits are all very close together. We're within hundreds of meters of each other. Surface sampling at A-Bear Brent of 11 meters of 7.55 grams. The Barney, just to the north, 22.4 meters of 6.35 grams per ton. The areas that we've been working on recently are Sam Otto and Miss Pickle. Miss Pickle is a high grade, similar to the other ones. We have our best intersection on that one, 8 meters of 60 grams per ton. And that was preceded by a 7.3 meter at 23 grams per ton. Just south of it is Sam Otto. We had a drill intercept there of 49.7 meters of a gram. It's a high grade or a low grade bulk tonnage situation at Sam Otto. So these are all quality targets. So you could build a company on any one of these zones, and we've got the good fortune of having 5 or 6 of them. Just to talk a little bit about some of the recent work we did, right in the center of the drawing is the Miss Pickle area. The red bar is the zones that we've already outlined. We've got about 35 drill holes into that zone now. This winter we did some drilling around the other targets in the area. We've had good success on the drill holes that we drilled to the north with zones indicative of high-grade mineralization similar to Miss Pickle. And this is just a cross-section of Miss Pickle. You've got a broad zone of low-grade mineralization, and within it you have these high-grade chutes. This was the most recent section that we drilled. So we have a main zone and a hanging wall zone, and the best intersection on that one is a 6-meter intersection of 29 grams per ton in the hanging wall. This is the Sam Otto that I talked about earlier. It's a broad zone of mineralization. You can read the numbers there. So you're looking at very broad, 120 meter wide zones of half gram. Within that are cores of 20 to 30 meters of gram and a half. We've been able to follow it now with drilling for 1 kilometer of strike, and it's still open. So it's looking like a good target, and we've also drilled it with continuity of mineralization to a 300 meter depth. Just to the west of it is a zone we call Dave's Pond. It's a narrow, high-grade zone. We put a hole into it last year and got 2.4 meters of 10 grams per ton. We've just announced 6 more holes on that structure, so now we have a continuous 400-meter strike length on the Dave's Pond. So it's very nice to have a bulk scenario sitting right beside a high-grade zone for a sweetener. And then just south of the Con mine, the Con, as just a reminder, was a 6 million ounce producer. The namesake Con shear extends right onto our property. It goes for 5 kilometers. We've been able to surface sample those structures over the last year, and we went in there this winter and did some drilling on the south belt. So we put 5 holes into the Con shear, and we put a hole into what's called the new vein. And we don't have any assay results for those, but the hole successfully cut all of those structures with good-looking mineralization. So you can wait for the assay results as they come through. The takeaway message for this is small junior controlling a major company or a major belt. It's 100% owned. We don't have anything hanging off in the background that's going to destroy our ability to bring this project forward. Our next threshold will be to bring ourselves to an ore resource. We want to put out a number that will be well north of 1 million ounces, and we think we can do that. Ultimately, our target is a Con or giant style with 5 or 6 million cumulative ounces. And so we just finished the drill program a week ago, and we'll be back drilling and doing field work come June, once the snow and the ice leave. And that's just, you can reference all of the stuff I was talking about there from our press releases, and there's a list of warrants and options, and my time is pretty well out. Thank you.
So we have a slight change in schedule. Our next speaker will be Colin Kettle, co-founder and CEO of Palisade Global Investments, which is an offshore merchant banking group focused on the resource sector. He comes from a family with deep ties to mining and many past successes, including co-founding AUX Ventures, the company responsible for discovering the Long Canyon deposit, which was ultimately acquired by Newmont Mining for $2.2 billion. So welcome to the stage, Colin.
Okay, perfect. Excuse me. So first of all, thank you to the organizers of Minds and Money for bringing this show to New York. You know the market is still really bad when they give a 20-minute talk to a 26-year-old, so stay in the room. Today I want to talk to you guys about private placements, which in my opinion, if you're investing in the resource space, and you're not taking advantage of private placements, you're making a massive mistake. And some of these concepts are probably going to be rudimentary to a lot of people in the audience, but I want to go over some of the basics and then kind of get into a little bit of what we look for in making investments via private placements. So the first thing I'm going to go over is just what is a private placement for anybody who doesn't know, and what is a warrant, because a warrant is arguably one of the most important financial tools to creating wealth in the resource space. And then I want to go over some of the criteria that we use when investing in different companies and when looking at warrants and what the best kind of private placements are. Just a brief background on who we are. Sean Zubik's my partner. He's not in the room right now, but he's walking around. You can't miss him. He spends a good amount of time dyeing his hair bright yellow every month. So he's the guy with the yellow straw hair walking around. And we started Palisade Global Investments 4 years ago. I'm going to go over a few of the investments that we have at this point, just to give you an idea of what kind of companies we're looking for, and to do a little bit of a selfless promote here on 4 of my favorite companies. There's Sean walking in the room right there. Also, you might know me from Palisade Radio, which we call the largest investment discussion platform in the mining space right now. You go to palisaderadio.com if you're not already subscribed, and we talk to people like Rick Rule, Rob McEwen, Eric Sprott on a weekly basis and send that out. So I just want to go over 4 companies real quick. The first one's called Palisade Resources, and it's a company that we actually incubated about 18 months ago. We saw an opportunity at the time that resource assets were going for almost free. Past producing mines were being given up basically for taxes and work commitments on a project because the landholders simply couldn't afford it after 5 years of a bear market. And so we put a little under $1 million together and went and acquired 28 projects across Canada and the U.S., Newfoundland, Ontario, Saskatchewan, and Nevada. And Ivan Bebic spoke here earlier. He's got a company called Stratton Resources, now called Torque. He's the largest landholder in Newfoundland, and we are the second largest landholder. We're parallel in our deposits there, so we're very excited. Just raised $5 million privately from some very big names. We're going to be taking that public in the next year. From a public perspective, our largest position is a company called Triumph Gold. It used to be called Northern Free Gold. Very quickly, 6 million ounces gold equivalent up in the Yukon, right near Kaminak's deposit, and it's trading at just a $30 million market cap right now. We were the largest shareholders until Goldcorp came in for 20% last month, and we're excited to have them as partners in the deal. This next one is a brand new name, but the company's been around for a while. It's called Mexican Gold Corp. And this is right on the cusp of a maiden resource, which is going to be coming out in June. Our internal geologists and mining engineers have estimated we're going to have over 1 million ounces of gold here, and this is on a company that's trading at roughly $10 million market cap right now. So really deep value sort of opportunities that the market has not paid attention to yet. Finally, the last one is a company that's also just been rebranded, and it's called New Age Metals. It's the largest undeveloped platinum and palladium deposit in North America. The company is actually here if you're interested in talking to them, and we've just got about a 15% position as of the last couple weeks. It's trading for about $1 per ounce in the ground of 43,101 gold equivalent. So here's the crux of my talk, and I'm very passionate about this. I'm passionate about two things in life. The first one is how to pay the government as little amount of money as possible for what I earn, and I live in Puerto Rico for that reason. And the other one is private placements and financing junior stocks. And I'm just going to take a sip of water real quick. I'm going to kind of break away from the presentation for a second and tell you a quick story. When I was about 10 or 11 years old, my dad got interested in the resource sector. He was an engineer for companies like NASA and Boeing, a very intelligent person. And we lived a comfortable life, but all of a sudden in about 2001, he decided to start investing in the resource sector. And that included investing in existing companies, but also going out to Nevada, Arizona, and Idaho and staking projects of his own. And I remember getting picked up from school one day when I was about 12 years old, and my dad told me that he had just staked a past-producing uranium mine in Arizona. And I thought, wow, that's really cool, but what the hell is that supposed to mean? And I watched over the next few years as he built a private company, and this uranium mine, which he had staked for $20,000, ended up getting a takeover bid for $70 million 5 years later. And also a gold property he was the first one to stake, got taken over by Newmont ultimately for $2 billion. And I got incredibly excited about all the facets of the business. And in a bit of humor, he would come home several nights in a row and open the door and say, hey, I made $100,000 today on these private placements. And my mom would say, oh, that's nice, honey. And then I would end up being the benefactor of him explaining all this as we went on walks for 2 hours a night. And he'd tell me about all these things like grams per ton of gold in the ground and millions of pounds of uranium in a 43,101 resource. But he also told me about one concept which I now consider to be the most important financial tool for wealth creation in the resource space, and that was a word called warrants. And my 12-year-old brain could not possibly understand what the hell a warrant was. I couldn't understand how you could have an option to purchase something at a later date and sell it. But finally, after some time, I grasped that opportunity. And that's something that is a big focus of what Sean and I are doing at this point in time. And the definition of a warrant, I think most people in this room know, is the option but not the obligation to purchase an additional share of a company at a set price during a set period of time. And so I'm going to put that into a very practical setting here in a second. But there's three basic advantages to going into a private placement as opposed to buying in the open market. The first one is warrants. The second one is sometimes you get a very good discount to the market, so you can actually buy at a cheaper price. And the third one, which we've taken huge advantage of lately, is the ability to acquire large positions of a stock. If you want to buy 10 or 20% of a company that's a 3 or 4 million market cap, you might drive that thing up to $30 million before you get your position. And nobody wants to end up paying that kind of money if they don't have to. So I'm using a practical example. New Age Metals is a company that I mentioned we just bought into. Their stock was trading at 9 cents a couple weeks ago, and we put a financing together at 7.5 cents with a 5-year warrant at 15. So the first thing is you're getting a discount to market here of roughly 20%, 18%. meaning I'm paying less and getting more shares, but we also attached a 5-year warrant on that at 15 cents. And practically speaking, if that stock goes to 75 cents, for example, at any time in the next 5 years, rather than buying at 9 cents and selling at 75, I'd be making maybe 8 times my money. With that warrant, you're making closer to 20 times your money. It's a very easy way to understand why the warrant and investing with private placements is so important. And just in case you don't know this, if at any time in the next 5 years the stock is, for example, at 75 cents, you can buy on that very same day your units at 15 cents because you have that warrant, and sell them the same day for 75 cents. And so you lock in that option, that opportunity on that asset. I think it's important to understand why there are warrants in the resource space. People always say, the old adage, that there's 1 out of 3,000 potential targets becomes a mine. And so those odds are stacked against you. And there's things that you can do as an intelligent investor or speculator, like look at the management team, or look at the share structure, or look at the deposit and maybe the existing deposit or indications, and maybe narrow that field down significantly. But no matter what you do, no matter how good you are, you're going to have more losses than wins. The wins, therefore, need to be significant in that they outweigh your losses, and the way to magnify those gains is by having a warrant. I use this example, and usually in audiences that are less familiar with resource investing, just to kind of explain the resource sector, but I like to say technology is actually very similar. You have companies like Apple, Microsoft, Google, Facebook that make up the top realm of the technology space. And they're constantly looking to add new products and technologies to their users. But there's thousands and thousands of ideas, thousands of apps on your phone, and most of them stink. Most of them don't end up picking up critical mass, or that they don't actually end up working. And so you'll end up getting these special companies like a WhatsApp or a Skype, which Facebook or Microsoft is willing to pay $19 billion or $8 billion for, because they can't apply the resources to try out thousands of ideas. And it's the same thing in the resource sector. Is a company like Newmont or Barrick cannot possibly go explore from the grassroots 3,000 potential targets to find their next mine. Instead, they're willing to wildly pay a fair value for something when those resources have already been found. And if you're invested in those companies, then you're going to make a lot of money if you're properly invested. There's two different reasons to use warrants. The first one is to answer an unanswered question. So you think that there's gold in the ground, and so you go ahead and invest in this company. And at some point you find out either yes or no, there's a significant amount of gold mineralization in the ground. And the other reason is you like a commodity. So you think that gold is going to go from $1,200 an ounce to $2,000 an ounce. And so you're playing on what's called optionality, or something going from not being worth anything in current price environments to being worth a lot. Our largest holder, Triumph Gold, is a very low grade but massive deposit that went from being worth hundreds of millions to $3 million when we got invested. Nothing changed except sentiment in the market because of the price of gold. And so warrants give you the upside to either finding out an unanswered question or the upside on the price of a commodity. A few things to look for when you're dealing with a company or when you're trying to get positioned. And I think these are very important. The first one is, are you getting offered a full warrant? Are you getting offered a half warrant? Some people have even offered me a quarter warrant, and I say, why even give me a warrant at all if you're going to give me a quarter warrant? So you want to see how much additional coverage you're getting through the warrant. The obvious other important facet of an option or a warrant is the time to expiry. So do I have 12 months to find out this unanswered question, or for gold to go to $2,000, or do I have 5 years? The longer you have, the more valuable that warrant is. The warrant premium, if my stock is trading at 10 cents and I'm offering you a warrant at 50 cents, that's not very attractive because it's a 400% premium until that warrant gets in the money. We really like to look for warrants that are within 50 to 100% premium above the market. And then the final one is the accelerator. Sometimes companies place accelerators on their warrants, which means they're going to force you at a certain price to exercise that warrant. And that takes away a lot of upside. And so in certain cases, you might not want to go into companies that are offering accelerators. I want to talk about when it's a good time to maybe sell, because if you have shares if you have units that you're offered in a private placement and you get a share and you get a warrant, at some time you can sell the shares. You hold on to those warrants; they stay with you till expiry, and you get the upside of the company or the commodity just by having that warrant. And if a company is trying to answer a question, is there copper in this deposit, and the stock's at $1, and you get in at $1 with a warrant at $1.50, and in the anticipation of them drilling their first hole, the company goes to $2 without answering that question, I think you would not be very intelligent to not take some of your money off the table, maybe all of it, because if that drill hole does hit and the stock goes to $5 or $6, you've taken your principal off the table, and then you ride that success with your warrant. And so the warrant also offers you a way to mitigate your risk in a very risky sector, being resource speculation. I just wanted to put up a practical example here. It's something, it's fun in 9 months of kind of bad markets right now to have a success. And Sean and I put a small check of $50,000 into a company called Camino Resources, which is looking for copper in Peru just 2 months ago. The placement was done at 20 cents with a full warrant at 25 cents. Their first hole hit 100 meters of 1.3% copper, and the stock shot up from 20 cents to $2.20. It's since come down to $1.13. But without the warrant there, if you just bought in the open market at 20 cents, you made about 10 times your money. With that warrant, you're almost double that, about 19 times your money. And so if a company has a placement open and you like that company, there's little reason to not take the money and invest it through the placement as opposed to just holding it in the market. I get questions from a lot of radio listeners on how to find private placements. A lot of times if you see one in the press release in the newswire and you call the company, it's already full. And the reason that happens is oftentimes the companies subscribe their placements before they announce it to prevent the market from selling off. So just some basic ways are brokers working with a group like Sprott. Rick has good access to deals. Press releases you can find with the risk that they might be full already. Newsletter writers, one of my favorite newsletter writers is in the audience right now, is Jeb Handwerger with Gold Stock Trades. He's got access to deals. And then groups like us, we have a private placement investor club that if you want access to deals, you can talk to us about getting involved in. One kind of last piece here is if you're an American, which there might be quite a few in the room since we're in New York, you're at a very steep disadvantage to Canadian or offshore investors because your hold period is essentially longer. You might never get your shares freed up, so it essentially slows down your use of capital, and it's hard to find brokers aside from Sprott that'll even open an account that can deal with this. You have to be accredited, so you have to be able to show that you have $1 million net worth or make, I think, $200,000 a year. And it's probably best to work with a premium broker who can deal with things like depositing these shares and exercising warrants. I just put a quick chart together here to show Palisade's portfolio as opposed to the HUI. The HUI is the 16 largest gold mining companies listed in the U.S. Since the bull market started. And most of this is the fact that we have spent the last 3 years in a bear market picking the best companies and getting warrant exposure to those companies. And you can see the results of that. And this is only the beginning. When things really move and you have a 4 or 5 year bull market, I think you're going to see some pretty exceptional gains in a portfolio with warrants as opposed to one where you're just trading on the open market. So that's the end of my speech. It looks like I've got 2 minutes left. If anybody has any questions, I'd be happy to try to answer. The question is anti-dilution provisions in the warrant. Unfortunate fit from the sector. The biggest cost in anybody's life is a government sticking their hand in your pocket, and I refuse to have any of it. So I went from living in Guatemala to now Puerto Rico, and I'll go to Alaska if I have to keep 0%. Perfect. Okay, thank you so much, everybody.
Thank you, Colin. Okay, so we have Rye Patch Gold up next. Bill Howald is the president and CEO. And after this presentation, we have a 20-minute afternoon break, and then we'll come back and we'll have the very exciting panel discussion. So welcome to the stage.
Thank you. Okay, thanks for the opportunity to speak here today. That was a great picture of me from about 20 years ago, so I appreciate that too. So, forward-looking statement. A couple things I wanted to get across during the presentation. We're Nevada's newest gold producer, and we're ramping up to production, and we've got a way forward to become the next mid-tier gold producer in North America, and I'll show you how we're going to get there. Okay, slides are here. Okay, so we just recently completed a restart of the Florida Canyon mine. In our plan, we did it at $1,000 gold, and we're ramping up towards 75,000 ounce annualized production. We just poured our first gold off the new pad in April, the end of the month, and we're ramping up towards about 6,000 ounces per month. That'll be that 75,000 ounce run rate. We've got an expansion plan that we'll start to look at here in 2018, where we can get to 100,000 ounce production out of the mine. That's nothing new for Florida Canyon. In the past, it's done almost 150,000 ounces per year. So we'll see that come through, and we'll talk a little bit about that. As I said, we just poured our first ounces in April. We've got a really good team. We wouldn't have been able to do it without the team that was in place. We've added and augmented that team with some really good hires, and we're fully staffed right now at about 175 folks operating at the mine. I'll show you how we're going to organically grow. This was really a unique opportunity for Rye Patch in the fact that we already had roughly 2 million ounces of M&I resource sitting in the district, and then we were able to pick up an operating mine. The Florida Canyon mine has the opportunity to produce over 180,000 ounces a year through its ADR and refinery, and that'll be important as I show you how we're going to expand. So Florida Canyon's been around for quite a while. It started life in 1986. It had a 3-year mine life. And 30 years later, it's still producing gold. And in fact, we produce gold off the existing heap leach as well as the new heap leach pad now. You can see most of that gold was produced when gold was between 300 and 500 ounces per ton, or price per ton, or per ounce, sorry. And they put about 3 million ounces onto that leach pad and produced about 2.4, 2.3 million ounces out of it. So that's that 68% recovery off the leach pad. When we came across the asset, it was owned by a Japanese bank. That bank built golf courses and condominiums in Japan and China, and so having a gold mine in Nevada was quite a foreign type of operation for them. We were able to get our foot in the door, come to an agreement, and we closed that acquisition in July of last year. It was fully permitted, ready to go. All we had to do was add the capital and build the new leach pad, build a crusher, and refurbish the mining fleet that was there. What's really good about Florida Canyon is, there's really 3 main drivers that drive economics in a gold mine. One is grade, one is metallurgy, and the other one is its ability to have a good strip ratio or geometry. When you look at Florida Canyon, it's really a low-grade gold operation. So from a grade point of view, it probably gets a D. But as far as metallurgy go, it gets an A+. Most of the gold falls out in the first 30 days, so you get quite a run rate on gold coming out of the pad. And it's also got a good geometry with a little less than about a 1.5 to 1 strip ratio. So those are really the 3 things that make mines fly. The other thing we liked about it is it was going to cost about $25 million to build the new leach pad and crusher and so on. And at $1,000 gold, what we saw is you got an NPV of over $50 million. So we like that ratio of 2 to 1 NPV to CapEx. And again, that's another key ratio. It's a lot of times you see these projects, you put $400 million in to make $50 million NPV, and those don't really work so well. As I said, we did everything at $1,000 gold, and you can see at $1,100 gold, and therefore and above, it's really makes a lot of cash. Okay, so the critical items really were we had to build a leach pad. So this is our leach pad with some ore on the lower part of it. We had to upscale the crusher. There was an existing crusher at the Standard mine, so we took that, we upgraded it from 5 million tons per annum up to 7.2 million tons per annum, and we think it'll do a lot more than that. And again, that's going to be important as we move to our expansion. The fleet, we had a full complement of fleet, 12 785s or 150-ton trucks, 3 loaders, 5 777s, graders, water trucks. The whole thing was there. They just needed a little bit of upkeep. We did some replacement and rebuilds on the engines, some replacements of some transmissions and things like that. So we spent about $3.5 million upgrading and refurbishing the fleet. And then, as I said, in April, we did our first gold pour, and we produced about 500 ounces for the month of April. And that's currently ramping up. We're over 100 ounces a day now, and that'll ramp up to that 200 ounce per day as we move towards our commercial production goals. Okay, so as I said, we bought the mine in July, the end of July, 1st of August. We took possession. We started our leach pad and building out this new restart program. Of course, we had one of the worst winters we've ever seen in Nevada for quite some time. We got, in the end of October, early November, we got half of our annual rainfall in one day. So it was quite exciting times at the mine. I don't know if you saw the leach pad, but part of it is a clay underliner. And clay and water make mud, and there's not really a lot you can do with mud. You are building an engineer design structure, so it's got to meet all the QA and QC before it can go into production. But we were able to get through that and complete everything, and now we're making gold. So we started mining on November 1st. We actually started stacking material on the pad at the end of December. It was actually December 24th. It was quite a nice Christmas present. And we started making gold off of that new pad in April. We'll be at our full run rate here, commercial production, by the end of Q2, early Q3. Okay, what I want to turn our attention to is then how we're going to get to that next step, how we're going to become a mid-tier producer. So in the district, as I said, this really was a unique opportunity for us in that we already had a number of resource projects nearby, Lincoln Hill and Wilco to be specific. So we control roughly 45,000 acres of land along what we call the Oriana Trend. And we have there Florida Canyon at the top, the Standard Mine just south of it, about 6 miles south, and then Interstate 80 connects Wilco and Lincoln Hill. So that whole trend is about 30 miles long. You can drive it in 25 minutes along the interstate. And what we have is production at Florida Canyon in 2017. We're going to look at this expansion from 75,000 ounces to 100,000 ounces at Florida Canyon coming into 2018. And that's just a matter of buying some more trucks, upgrading the crusher, and looking at some more ounces around Florida Canyon itself. Lincoln Hill is where we kind of started the whole process. We had Lincoln Hill. We were moving it towards production, and the goal was to get it into production by 2019. And that's still on task for production 2019. And then Wilco would come in later. We don't have a PEA on Wilco yet, but we're working towards that. And then what we'd be able to do is use the facilities that we have at Florida Canyon to truck the carbon back and forth. So if you go and you look at our PEA at Lincoln Hill, the mine cost about $40 million to build as a standalone operation. Having Florida Canyon probably lowers that to about $15 million because we don't need to build things twice. It's only 20 miles away. We can build a leach pad, a pond, a carbon plant, and truck the active carbon up to Florida Canyon and strip it. And remember what I said earlier is Florida Canyon can do 180,000 ounces a year through its ADR and refinery. So we have plenty of capacity left there for things like Lincoln Hill and Wilco. So we're going to build our way up to a mid-tier producer. We'll be producing over 200,000 ounces within the next 48 months. Let's just look at some targets around the Florida Canyon. We're in New York City. I like things to be big league, if you know what I mean. So this is some big league oxide and sulfide targets. In oxide, we think we can add another 1 million ounces to that resource. We've got a number of dumps around the Florida Canyon deposit itself that we have to move anyway. There's some drill holes through those dumps that show that even though it was waste material maybe 30 years ago, today it is ore grade because of the gold price. And so, we have to move it anyway. And so it's a matter of, do we move it to a waste dump facility or put it on the leach pad? We feel there's about 500,000 ounces sitting in those dumps right now. So we'll capitalize on that. We've also got some areas in the resource itself that have never been drilled. It's quite interesting. They only drilled on the ridges. They never drilled in the valleys. You've got kind of a flat-lying structural zone that there's no reason that it shouldn't be mineralized in the bottom of the valley as well as it's mineralized at the top of the valley. So we'll drill those areas out and add some more ounces. And then what's really interesting to us is there's roughly 250 drill holes that go through the oxide into a sulfide body beneath Florida Canyon. The average grade of those 250 holes is 2.5 grams, or about 0.75 ounces per ton. Back in the mid-90s, Pegasus Gold, who owned Florida Canyon, did a feasibility study on those sulfides. It pulled a whittle pit at $400 gold, albeit a different cost structure. But what's really interesting is the gold came out in a real simple flotation cell. They were able to produce a pyrite concentrate. It was about 10 to 1, and they got 94% of the gold. So if you can do a 10 to 1 concentrate, 10 to 1, that's 25 ounce material or 25 gram material in the con. And what we think right now is there's room underneath there for maybe 3 to 5 million ounces of that sulfide. And so we want to get on drilling and looking at that. Okay, just looking at some peer comparisons. This chart is a bit old, but right now we're trading at about 0.35 of our net asset value. So that's the value proposition in the stock. As I said, we're trying to expand, and we'll get up to those mid-tier production levels in the next 48 months. Just a little bit about the team and myself. I came out of a company called Placer Dome. I ran Placer's U.S. and Latin American exploration programs for them. Was intimately involved in all of Placer's operations throughout the Americas. A lot of those operations are now owned by Barrick. Tony Wood came out of Prodigy. Prodigy sold its primary asset to Argonaut and was a very good value for shareholders. John Porterfield and I have worked together for over 20 years. John's built mines in Papua New Guinea and Nevada, has been a mine manager and also a construction manager. And he managed all of our construction and is now the acting mine general manager. Ronaldo is another guy I met 25 years ago in Brazil. He's an excellent geologist. He's been able to put a lot of resources together and make deposits out of them. So he's pretty good at finding it and making it pay. And then we wouldn't have been able to do it without the team that we acquired at Florida Canyon. So we acquired pretty much all of the general foremen and whatnot. Some of these guys have been there over 20 years at the same mine site, and they're phenomenal. We've been able to augment them with some more senior superintendent types that we've been able to lure away from the likes of Newmont and Barrick. So we're building a really good team at the mine, and these guys are going to get it done. A little bit about our balance sheet and capital structure. It was really a transformational acquisition for the company. We were a $20 million market cap company, and we went out to the market and raised $65 million. And in doing that, we were able to get a credit facility from Macquarie Bank and then equity with our equity partners of Macquarie Bank and Canaccord. We currently have a debt, $27 million in debt, which we just drew the rest of that facility here last month, and we're sitting with about $8 million in cash. So these are some of our major institutional investors, Donald Smith and the Van Eck Fund here in New York, obviously Sun Valley, Taylor Asset Management, and U.S. Global out of Texas. And then here's some of the analyst coverage that we have. So that's it. We're in production. We've got an experienced team. We've got a huge land position in Nevada. There's not very many folks that have those positions outside of Newmont and Barrick. So the more you drill, the more you find. Nevada's a great jurisdiction, and we think there's a real opportunity to create a lot of value in western Nevada. So thanks for your time and your attention.
Thank you very much. We're now going to go into a short break, and we will resume at 3:40, 20 to 4. Thank you very much.
Was there a question in the back? That's a good question. So the location of the where we're working is an old. It's really the last fresh water in Nevada before what the pioneers would go across, called the 40-mile desert. And in there, before the immigrants came across, it was an Indian camp, winter camp, and there were patches of rye that they grazed their horses and whatnot on. It later became a mining district as they went across the California Trail, became the last watering hole before you went across the 40-mile desert. Now it's a recreation area, but it's always been a place, a meeting place in the center of Nevada.
Test.
Testing 1, 2, 3. Okay, we're just going to dive right into it because I want to use the full time for this since we have an all-star panel. I'm very excited to discuss whether gold is just a dollar play or is there something more to it. As many of you know, when we read the latest articles from any financial publication, Kitco News included, journalists love to say, gold did this today because the US dollar acted inversely to what gold did. But how much truth is there? Is there really an inverse correlation between gold and the US dollar, or is it one of the greatest myths that exists in our industry? So we have an all-star panel here. Robert Cohen, Vice President and Portfolio Manager for Dynamic Funds. We have Marcelo Kim, a partner with Paulson and Company. We have Dan Oliver, the CEO of Mirmacan Capital. How'd I do on that pronunciation? Excellent. And Doug Groh, Portfolio Manager over at Tocqueville Asset Management. And Doug, I might start with you because when I interviewed John Hathaway a few years ago, he was very passionate about this topic, saying that it is one of the greatest myths that does exist. So do you agree?
Gold as a dollar play. Well, you know, I suppose if you want to take that argument, it certainly can be argued gold and the dollar are inverse to each other. And I think points in time you will find that gold trades inversely to the dollar. It's a matter of perspective, perhaps. What we have found and what our view is that over the long term, gold does not trade up against the dollar. Gold has a mind of its own, and I think that's the real beauty of gold, is that for investors around the world from different cultures, they can ascribe a value to gold all their own. It's really, I think, the merits of gold is that it has its own value. It's not tied to the dollar or the yen or the euro. And that's, I think, really the attraction of gold. It's a diversifier in a portfolio. But certainly there are times when it's inverse to the dollar, and I think you can find periods when it trades against the dollar. So traders will use it to hedge their dollar exposure.
Anyone else have thoughts on this?
I had an event with Paul Volcker 2 years ago, and he got up and said when he was Fed chairman, gold was the enemy. And I think that tells you what you need to know about how the Federal Reserve views gold. But I disagree that it's a dollar play in that the reason gold has served as money for the past 4,000 years is because it's the most stable element that there is. And that hasn't stopped since Nixon took us off the gold standard. If you price oil, for example, in terms of dollars on an annualized basis, taking monthly, the standard deviation is 64%. If you price oil in terms of gold, it's 40%. So the point is that prices become more stable in gold terms, and that is why gold is money. And so these financial commentators wonder what's happening to the price of gold. Really, the question is what's happening to the value of the dollar. And when you say that, you come across as a crazy gold bug, but the reality is that at least you have good company, and that's how the world's operated for 4,000 years.
That's my thinking pattern exactly. I try to break this notion of, you know, when we look at gold price, everyone says, well, it's priced in U.S. dollars. It's not priced in U.S. dollars. It's most often quoted in U.S. dollars. And the way to think about gold is a currency. And the way to think about it is not dollars per ounce, but ounces per dollar. Think of the reciprocal. Gold is really not doing anything. It's a dollar that is changing. What moves the dollar? Monetary policy, inflation rates, geopolitical risks, the VIX. Things like that move the dollar. So gold price in any currency is an expression of what that currency is doing. So I know we're in the U.S. right now. I sit in Canada. I wake up every morning. I look at the gold price in Canadian dollars per ounce. If you're in South Africa, you look at it in rand per kilogram, because that's what matters. What are my alternatives to owning my local currency? I can own another country's currency, or I can own gold. And I dumb it down to just that.
I think, sorry, Marcelo.
Yeah, I would just say maybe I'm a little, we don't identify ourselves as gold bugs necessarily, or have the view that we should always be involved in gold. We think there's times to be involved in gold, and our involvement in gold really began as a consequence of all the money printing that took place in 2009. And, we see two reasons to own gold. One is if there's going to be a banking collapse, which we almost did in 2009. And the second one is inflation. And inflation has a lot of factors, so it's not necessarily that gold is a dollar play. To even define it as a dollar play for me is confusing because you can use the DXY index, you can use the trade-weighted index, and there's all sorts of different relationships. What we've found is real interest rates are really the best proxy for gold. And the reason why that works is you can hold money, you can hold it in cash, or you can hold it in some other asset. When the real rate of return is negative, when we've looked at it from the 1970s onward, gold return has been very, very good when interest rates are negative. It's almost like a breaking point, or when there's a big move towards being very positive to being negative, as we saw sort of from 2000 onward. So we think the biggest proxy is real interest rates as the driver of gold prices.
So would anyone else argue that gold's next move is really about rate hikes?
I wouldn't say it's necessarily about rate hikes. It's what rate hikes are doing with respect to an inflation. So rate hikes are a number that we see. It's an absolute number. It's posted. Obviously, the Fed's comments today were hawkish. There's room on the table for a hike in June. But what will inflation do between now and then, or now and the end of the year? I think inflation will start hitting the headlines more. Okay, and so what you need to look at is real rates, not just the...
So when you're looking and analyzing the gold price, that's the number one for you, Robert?
Number one is monetary policy, followed by real rates, followed by another 3 factors. And with a 5-factor model, we actually have a 98% R-squared on our gold model, which means that there's no manipulation in the gold market. There was a talk about that earlier. We have a 2% error term. So, if you're going to fuss over 2%, well, maybe that's where there could be some. But I'm just working with a simple 5-factor model. I don't want to make my model too complicated.
I'd be interested to know what the other panelists, which factors you consider the most important when talking gold price.
If you're looking at the dollar price, I think interest rates are important, but I think interest rates have two different kinds of effect. One is, if we think about the dollar system as a system, there are $4 trillion in existence. That's the monetary base. There's $90 trillion of dollar-denominated debt that demands interest payments all day long. And so you always have the potential for a short squeeze on dollars, and when they raise rates, what happens is that the dollars you need to maintain your debts increase, so people need to hold more dollars. The dollar gets stronger and gold gets weaker. That's the first order effect. But there's a longer-term, more powerful effect, and that is that all the dollar really is today, it used to be a unit of massive gold. Today it is a unit of liability of the Federal Reserve's balance sheet. And the Federal Reserve holds now very, very long-term bonds. And rising rates devalues those bonds extraordinarily quickly. If you look back in the 70s, as interest rates went up, nominal interest rates went up, the bonds in the Federal Reserve's balance sheet devalued and gold went crazy. So at some point when that short squeeze breaks, and it will, rising rates will play into a collapsing Fed asset base and a soaring gold price.
I think as an investor, one has to look at the cost of money first up, and interest rates dictate that cost of money. But ultimately, you really want to look at the real rates, the real cost of money. So real rates would be the first priority you want to look to, and then, of course, inflation, an indicator of the devaluation of money in the marketplace. And so those are really the key indicators, I think, for investors when they're looking at purchasing gold or having a gold exposure.
Robert, you kind of alluded to it before, the debate of whether gold is a currency or not. Some would say it's just a safe haven. Some would say it's absolutely not a currency.
I think it's very much a currency. You got to think about it. As long as somebody's going to perform a good or service for an ounce of gold, it's a currency. And we talked about pricing, as Marcelo mentioned, Daniel mentioned in terms of oil. You can look at it in terms of hard assets. You can look at the value of your house in ounces of gold and being more stable when measuring it in ounces rather than dollars. It's a dollar that is not stable here. And so it is a currency. We produce some gold every year, but against the base, because not to my knowledge, no one's really purposely thrown out any gold that's ever been mined in the history of mankind. So there's, 175,000 tons thereabouts out there. If we mine 2,500, 3,500 tons a year, we're expanding that monetary base at a rate of, say, 1.5% per annum versus paper money currency that can be expanded at a much faster rate. So that's really why gold price goes up through time, is this expansion of monetary policy. And as Marcella mentioned, 2008, 2009 was that huge expansion. We had that huge jump in the gold price to where we are now. And where we go forward from here, we still have loose monetary policy around the world. We still have real rates hovering around zero, probably going to go negative if we have any acceleration in inflation, which I think is coming. Just hasn't been a theme for like the last couple of years.
I would just add to what Robert's saying is, or Rob rather, I can call you Rob, is since the Fed embarked on QE, the monetary base in this country has gone up by 330%, which if you look back historically is unprecedented. Even in the 1970s when the U.S. had double-digit rates of inflation, you didn't have that sort of expansion in the monetary base. Historically, the monetary base times 10 correlated very well with the money supply in this country. But since 2008, that relationship has broken down. So I think the monetary base times 10 is somewhere around 37 trillion. So 3.7 trillion is the monetary base. But the money supply is still only about, if I'm not wrong, about 14 trillion. So there's still about a, if that relationship came back, potentially something around $20 trillion of credit that could be created. And to put that into context, the U.S. GDP is $18 trillion. So it's a massive amount of money that's been printed. The only reason why we think that hasn't been in the system is because excess reserves that the banks hold with the Federal Reserve have gone up by about $2.2 trillion. They used to average something like tens of billions of dollars before the crisis, and right now they stand at about 2.2 trillion, I think. So that is that mechanism by which the banks, if they withdrew that money with a multiplier, whether it's 5 times, 10 times, that's where you get this explosion in money supply. And money supply is really, historically, if you do the log return of money supply and the log return of the gold price, it correlates very well. And so ultimately, if you do have this explosion in the money supply, we think the gold price could follow it accordingly.
So that said, I'd really like to get this going now by asking, could we see a return to a gold standard?
I don't think so. If you were to take the current M1 money supply and back it with gold, it would imply that the gold price for 100% backing would have to be over $10,000 an ounce. If you use the M2 money supply, you would have $44,000 an ounce. And that would mean everyone's going to quit their jobs and go gold panning and looking for little specks of gold in their backyard. It's just not feasible.
Yeah, I think
Dan's biting his tongue, I know.
I think I'll let you in a moment, Dan. But I think what's interesting would be a gold standard, but I think the world is in such a way, it's constructed in such a way that it would be impossible to have agreement among economic institutions, nations, to establish a gold standard. And given what politicians are all about, I don't think they would want to have a standard that they would have to be reliant upon. So I don't see that really feasible. And given our interconnectedness, I don't see quite the concept there. I think the beauty of gold, though, is that objectively all cultures see the value in gold. And that I think is important, that regardless of where you go in the world, people recognize gold as a valuable element. And I think in that regard, too, it gives investors an opportunity to participate in value without being involved in the institutional construct they might be participating in. In other words, as a diversifier to overall value or the investments that they might have.
Yeah, I love this question because, of course, everyone thinks we can't go back to gold standard because no one would choose it. The politicians won't choose it. And there's no question that's correct. Of course, the politicians will never choose to cut up their own credit card. But it's not that we might go back to gold standard. We will go back to our gold standard. It's inevitable. And I say that because if you look back, again, through 3,000 or 4,000 years of monetary history, this is not the first time the world has left a gold standard. It happens all the time. And when the credit bubble that inevitably follows collapses, the market returns to gold. The politicians don't. The market does. And in our modern era, it's happened already twice. As everyone knows in this room, probably FDR made holding gold a felony in 1933. Yet by 1942, the Fed's balance sheet was backed 84% by gold. So even though it was illegal for a person to have gold on their person, in fact, the dollar had returned to being a gold-backed instrument. By the time you get to 1969, gold backed the Federal Reserve assets by 9%. At a very low level. When gold crossed $5.50 an ounce in 1980, the Fed's balance sheet was 100% backed by gold. So again, a Federal Reserve note was, again, a fully gold-backed instrument, not because Paul Volcker chose it or the Congress chose it or the President chose it, but the market chose it. And again, today, gold backs the U.S. dollar by about 6%, about the lowest level seen over the last 300 years if we look at the Bank of England and the Fed. And that number will go back to where it has been historically of a third, not 100%. Usually money's backed by about a third gold. But in the crisis, it can go back to 100%. That number is around $24,000 an ounce. So that's a crisis high. That's not the equilibrium level, but the market will force it at some point.
But Dan, when you say it's inevitable, what time frame are you speaking?
That is the key question. The time frame occurs when the credit bubble implodes, right? And this has been the longest credit bubble the world's ever known, partially because we're not in our gold standard. Hayek said in the late 70s that he never imagined that credit bubble that went from the 60s through the 70s would last so long, because he didn't imagine without our gold standard the imbalances could get much, much greater. But the reality is what ends a credit bubble is overcapacity in very long-term asset-intense industries. They can't make their interest payments. The banks blow up and down you go. The Fed can print the money to bail them out, which they've done before. But eventually, again, as Hayek and Mises wrote, you either get hyperinflation or you get a big crash if they stop. And in either one of those instances, it doesn't really matter. That determines what happens to the unit of account of the currency. In either one of those cases, gold winds up being back as being de jure money or de facto money, whatever the politicians say about it.
I want to just give a little homework. This is a bit of an aside, but monetary policy has been always a debate in the United States. And I'm going to give you guys a bit of homework here. The 1896 U.S. presidential election was focused on monetary policy, and they were in a period of deflation then. The Midwesterners were suffering, and they couldn't expand the money supply because it was fully backed by gold. So there was a bimetallic proposal from the Democrats to add silver to the money supply. It didn't win. The Republicans won. The gold standard remained till World War I. But the historic aside is in 1902, Frank Baum wrote about the 1896 presidential election in a political allegory, which you've all heard of, called The Wonderful Wizard of Oz. So everything in that story is actually the political allegory from the 1896 U.S. presidential race. The Oz is the abbreviation for ounce, measure of gold. The yellow brick road is the path taken to Washington, D.C., Emerald City, painted green, color of money. And every character in there represents somebody. The Tin Man's the U.S. industrial worker, and Dorothy's a Midwesterner, and so forth. The Cowardly Lion is William Jennings Bryan, and so forth. And in the book, Dorothy's slippers are actually silver, not ruby. That was an MGM faux pas when they made the movie. So you got to go back and read the book, and then reread it with respect to the events of the time. But it was actually all centered on monetary policy. In the end, the gold standard did fail. And, FDR writing up...
It didn't fail, it was sabotaged. I object to that characterization.
I still don't agree with the free-floating exchange rate world we're in now, because not everyone is free-floating their currencies, which has caused problems with China, for example.
I guess another argument I hear often of why we wouldn't be able to is there's not enough gold to back a gold standard.
At the right price, there is. I mean, it just depends what price you're talking about. the right price.
It works under a fixed exchange rate system, but we're not in a fixed exchange rate system. We're in a floating exchange rate system with the exception of China. This is why Donald Trump has a beef with China. You can't be a major trade partner and fixing your currency. In fact, when we read our economics textbooks when we were younger, the benefits of international trade had assumed free-floating currencies. It does not have a special chapter for an economy the size of China, for example, manipulating their currency.
Marcel, did you have anything to no? All quiet on that. Okay, well, I started the talk by talking about the media's coverage and perception of gold. What would you like to see the media change? And this is a good lesson for me as well in their coverage of gold and the metals.
Well, I always find it fascinating when gold is on an upward move. The media certainly takes note, but only for so long, and then after about a 5 or maybe 10% move, the media starts pounding down gold. And what I find fascinating is the media will come out with a storyline or a headline saying that, well, gold is only up 0.5% today, or gold is down, it's down 0.5%. It's all over for gold. And the media seems to like to grab on the short-term news of the gold move and act as if, well, see, gold doesn't really serve as a very good barometer of fear or inflation or of interest rates because it's not really doing what we expect it to do. So it's really kind of fascinating that gold gets punched up a lot. It's just amazing how beautiful gold is, but how abused it is. It's dug up, it's blown up, it's ground up, but in the end, it still retains its value, and it's there despite everybody's efforts to really abuse it. So I would like to see the media be a little bit more gentle on gold, as it were, and give it a little more credit. Right.
There's a Greek word, hubris, which means outrageous arrogance. And whenever I turn the TV on, that's what I think. And the reason is that, again, gold has been money for 3,000 or 4,000 years. And the Duke Saint-Simon in 1720, at the conclusion of the Mississippi Bubble, wrote that it was pretended during the bubble, which only lasted 3 years, not 30 in our own case, that all the countries have been in the greatest delusion about money since Abraham, that only paper had value and gold was anachronistic. And that's where we are today. The media rejects 3,000 or 4,000 years of accumulated experience in history to imagine that somehow modern man has overturned human nature and history has ended and we're in a different phenomenon. And so people who like gold are crazy. So when gold goes up, they trot out Mr. T to make fun of it, and then, of course, ignore it when it's going down. And so it's this outrageous arrogance that modern man has, again, surpassed his own nature and his own history.
I guess my only two wishes, I already alluded to one. Instead of saying dollars per ounce, let's talk about number of ounces per dollar. So then people can get in their heads that it's the dollar that's moving and not gold. And the second one is kind of along with Doug's point. They talk about not the percent change, the 0.5% change example I used. They say gold's moved $20 an ounce today. Okay, that's 0.5%. Who cares? It's 0.5%. When oil moves 0.5%, people take that in stride and they attack gold because of the absolute price. Oil's $50 an ounce versus, or $50 a barrel versus something that's $1,250, and so a 0.5% change it sounds like a bigger amount when you're discussing something that's $1,250. Just talk about it in percent changes. I just don't like when they say, gold's up or down $20 today. It's a huge move. Why do you think this is happening? It's a rounding error.
But to answer your question, gold threatens the Leviathan. It threatens the existing order, and that's why, again, throughout history, it's been made illegal. What else has been made? I mean, Diocletian made holding gold a capital offense, as did Robespierre. Roosevelt made it 10 years in prison to hold gold. Why gold? Why not copper or any other substance? Nothing else has been banned the way gold has been over the centuries, and the reason is because it is free market money, and therefore it threatens the whole structure in which power in a country like ours relies. And so there's a lot of angst against it.
So before we open up questions to the floor, I'd like to wrap with your sentiment for the forecast for gold, where you see it headed. I know we don't have crystal balls, but...
On what, a 6-month, 12-month, 24-month?
Yeah, for the remainder of the year, let's say.
Well, I think there's a good likelihood that the Fed hikes rates twice this year. Once or twice, doesn't matter. I don't see an acceleration in inflation, though. If you look at credit metrics, loan growth is actually falling. Money supply growth is also falling. I don't know what will happen second quarter of GDP, but first quarter is actually remarkably weak. So even if, but regardless, if the Fed hikes only once or the Fed hikes twice, there's upward pressure on rates. And absent an acceleration in inflation, the real rate's going to move up. And I think in the absence of some geopolitical event, that could be negative for gold. On the other hand, with weak GDP figures, and it's hard to see how the Fed can normalize rates. In their statement today, they said that they're going to continue reinvesting the proceeds they receive from the instruments that they own until Fed policy is normalized. I don't know what Fed policy normalizing means, if it's a number, but the Fed can't hike rates and get to a position where they're in 3-4% without sending the economy of the U.S. into a big tailspin. So I think there's a good floor for gold. I can't see rates shooting up dramatically, but the impetus to hold gold, if you want to get very bullish, really has to be the rate of inflation accelerating faster than the increase in interest rates.
Robert?
Yeah, I don't have a particular target on gold. It depends, as Marcelo says, on what your inflation expectations are, what you believe will happen with global monetary policy, which is, of course, very hard to predict. I'd just like to have some gold at all times. It's a quintessential hard asset. I think paper money over the long term is a bad investment, and you need to diversify. And you can diversify. You don't believe in gold? Buy real estate. Buy another hard asset. But at least gold is a nice liquid hard asset that you can transact.
And you like physical gold? Are you buying it?
I like physical gold. I like gold miners because gold miners go out and find gold at a very cheap price. So I have optionality on the price of gold. I got the optionality on their exploration success. So I like miners. It's a bit of a hobby for me. So I like that.
Yeah, you asked what was in the bubble, and again, if you look back for the last 100 years in terms of the Fed and the Bank of England, the previous 100, whenever the dominant central bank starts raising rates, the bubbles collapse. I mean, the Fed started raising rates in early 1928. They did it for a year and a half until late 29, and then the bubble collapsed. So, when you're in a economy as we are that is unbelievably debt saturated, small increases in the interest rate can have huge effects on projects and the stock market, everything else. So I think given that we are in a rate hiking cycle, which they're doing to rein in asset markets, the time for this bubble is short. Now the big question is, when the big nightfall comes, do people sell gold because there's a big dollar short squeeze and so gold goes down at first, or not? I mean, back in 2008, you had a lot of levered hedge funds who owned gold, and they had to liquidate. All of a sudden, that's why gold went down. But the second that the banking system started to teeter, that's when gold got a bid again. And everyone remembers what happened in 2008. I suspect when the next big crisis comes, it'll be much faster. Everyone learn what comes next. So if gold does go down, which it may do at the first sign of big trouble, I think it won't be for very long, and the next leg higher will be very quick. Will it happen this year? I don't know if it happens this year or early next year, but I think the time is limited for this current bubble we're in, and gold will be a lot higher once it resolves.
Doug, final word.
Right, sure. Gold is so unique because it responds to so many different things, whether it's interest rates, monetary policy, the dollar's move, other currencies. I like to think of gold as really a measure of financial anxiety. And that anxiety might be interest rates, it might be inflation, it might be monetary policy. It seems this year geopolitical tensions around the world have really caused tremendous anxiety. And what we're witnessing is a relatively strong gold market despite expectations of higher real rates. And so you kind of have to ask yourself, where does that go Where do we go with that geopolitical anxiety? I think everybody wonders that. We don't know. But it is becoming more apparent around the world that in some ways the world is smaller, that we're connected to what's going on in Asia or Europe, the European votes that are underway this spring, or developments in the Australasia Pacific region. I think that you need to look at gold in terms of its objective value construct, and yet your question is, where's the price of gold going? And I think if we look at the last year or so, we see that there is good support of gold at the all-in corporate cost of production for the industry. When we touched the bottom at $10.45 or so a year and a half ago, that was pretty well recognized as the stop point for companies where they couldn't survive at a lower price. And we did see a number of companies begin to prepare to shut their doors. This past year, we came down to about $11.50, and that too, the gold price bounced off that. My sense is that as mining companies are having to mine lower grades, having more costs imposed upon them for their operations, we're probably at a $1,200 support level. And we've seen the gold price so far this year kind of come down to $1,200 and bounce up. So that being the floor, that's my sense of where we are on the gold price. We're at the lower end of the range. If we got up to $1,600 an ounce, I think you'd see a lot of supply come into the market, and I think you would see probably a reluctance to get to a higher level. What I would like to see in the next 12 months is the gold price break through last year's high of $1,360 or so, and I think that's very doable. I think with the geopolitical environment, the potential for inflation, monetary policy, we can see this somewhat of a stall out by the Fed here. It's really a pretty positive setup, I think, for better gold prices in the next 6 to 12 months.
Doug, Dan, Robert, Marcelo, thank you. I'm going to open up to the floor now if there's questions for the...
I'll just go to this gentleman here first.
My name is Amrit Bakari. I have a question. The panel seems to be talking about gold in U.S. And U.S. is not as dominant in the world today as it was, say, 40, 50 years ago. And we have to look at China. And interesting thing about China is the government of China, as well as the people in China, they both like gold. The government of China actually encourages the people of China to buy gold. So there is a very interesting situation. Normally, the government doesn't want the people to own the gold, but in China, the government is actually encouraging the Chinese people to own the gold. And if gold gets monetized, how does China factor into it? Nobody has thought about it. China is accumulating all the gold that is mined in China does not leave China, and yet they import gold. So actually it might be not surprising that the China, between government and the people, own more gold than the U.S.
So I think it's a great question, and you're absolutely right that usually governments don't want their citizens to own gold. I think in China's case, the Chinese government for millennia, their biggest interest has been stability, that they want stability. And so I think the Chinese know that the current system has a limited life, and by putting gold, as you say, out, distributing among the people, it helps ensure some stability when the current dollar standards collapses, which is going to do. So in that sense, they're extremely cunning, and as opposed to, of course, the West that's busy sending them our gold because the Keynesians has convinced us that it has no value. So I think they're very cunning on that.
If you look at the supply and demand, and it's hard to have a really good handle on that, the demand from countries like India and China, so something around all demand excluding investment is like 2,700 tons out of a 4,500 ton market. So really the swing mover of the price is the investment professional. I don't know where they are, but the way we typically look at it is holders of ETF and the COMEX. So if you actually look at the gold price for the last 4 or 5 years out versus the changes in the positioning of that market, it correlates quite well. And you can see that in the data as well. In 2013, when the gold price really fell off a cliff, the Chinese market really came to life. And I think they helped put a bit of a floor on the price, which otherwise would have come down. But I don't think the Chinese or the Indian people, I think they're a lot more price sensitive. And so they like to buy it on the dips, but they don't really like, getting too involved when it goes up higher, unless they have a real reason to.
I mentioned a 5-factor model that we run with 98% correlation. The only factor that I have that has anything to do with physical supply demand is why I just run the COMEX net longs as a proxy, which means you can analyze supply and demand all day long and you won't learn a lot. It really doesn't matter. There is demand for this gold. If it's not China, it's India. If it's not India, it's jewelers. If it's not jewelers, it's individual investment demand, or another country like Russia. It's just, there's an infinite amount of demand for gold, I think. It's just constrained by the supply. And within reason, I don't think the supply can really meaningfully grow. We mine about 3,500 tons a year. If it grows another 300 tons a year, it's a rounding error. It won't matter. And I don't even think the industry can grow that much because, as Doug mentioned, the grades are falling at mines around the world. It's just basically it's a monetary currency that can grow at about 1.5% per year. Like, mining gold is like printing money, but we can't print it very fast, which is the beauty of it. It keeps this from getting out of control. You want it to stay rare. And if you're only adding 3,500 tons to something that has a 175,000 ton base, it's a small amount. If you took all the gold in the history of the world ever mined and melt it into a cube, it would be a 5-story building cubed. It fits under the Eiffel Tower. It's tiny. It's not a lot of gold in terms of volume. In terms of weight, yeah, we'll start sinking into the ground. But in terms of volume, it's not very big.
Okay, so my head's spinning a little from everything I heard today. Now,
in a good way.
In a good way.
Okay.
Doug mentioned that he thinks that geopolitics is the determinant of one of the determinants of gold price. So I'd like to ask each, and you said, Marcel, that you said the Chinese and Indian demand. So I'd like to know, what do you think is the determination? I mean, I heard inflation. I heard the value of the U.S. dollar. I heard real inflation rate, etc. So all in all, if you had to name one or two of the most important determinants for the price of gold, what would they be? Thank you.
By the way, I didn't say Chinese and Indian demand was driving the price. In fact, it was the opposite. I said Chinese and Indian don't really move the price.
You said they buy on the dips.
They buy on the dips and maybe put a floor. But the swing producer is the ETFs and the COMEX. That's what I was saying. If you track the price of gold for the last 4 or 5 years, along with the changes in that positioning, it actually follows pretty well. So that was my point, is that China and India, because the gentleman behind you was asking the role of China and India in the gold market. And my point is they're there, but they're not going to move it, dramatically one way or the other.
I think the major determinant is financial anxiety. And I think the interest rate, the real interest rate environment is an indication of that cost of money, as it were. But there's a lot of different elements that go into the price of gold. And I think any given day it can be something different. One day it's maybe interest rates. One day it's maybe trade flows. Another day it's FX. Whatever traders are doing on the news that they're trading gold on. But I think if you look at the bigger picture, you think of why are people attracted to gold? Because they perhaps don't have trust in other aspects of the financial system. I think if you look at interest rates, that's the cost of participating in the financial system. So real interest rates, I think, are a good expression of participating in the system, a sense of the financial anxiety, which is expressed in gold. in a collective way. The gold price is saying something much broader than just the cost of money. It's talking about the flow of capital, the freedom of participating in the economy, monetary policy.
Yeah, and I'd like to go back to my original point, which I think you're asking the wrong question, because you're asking what determines the price of gold. And the point is that the price of gold is the most constant thing that man has found to measure value in 4,000 years. That's why he has a preference for money. So there are questions, what affects the price of the dollar? And that you have to look to, what is a dollar? It's a unit of liability of the Federal Reserve. So what's happening to the Federal Reserve's assets? And what's happening to the number of dollars versus the demand for dollars, which is determined by interest rates, by debt, people needing dollars to pay their debts, and so forth. There are other things that you can price gold in, for example, the cost of mining oil. And those prices are actually extremely regular. When you have credit levels rising and interest rates falling, gold falls in terms of commodities. Margins for gold mining shrink. And again, there's data, good data on this back for hundreds of years. And the reverse is also the case. When rates go higher and commodities fall, then the gold commodity ratio goes up and margins go well. So basically, gold is negatively correlated to the business cycle, and that's what makes it such a great asset to have in a portfolio, because it over time smooths out your returns.
One more question, quick question. Yep.
About the gold standard or lack thereof. I think the question is, it's Daniel, right?
Yes.
Oliver? Let's assume for the moment, and this can be a yes or no answer.
Yeah.
Let's assume for the moment that there is a gold standard in the U.S. And let's assume that price is not monetary. It just happens. My contention is that can't happen, even if it did happen, because then the miners control the bankers. So either there will be rules and regulations to undermine the transfer of power, as was alluded to. And price isn't a problem, and gold supply is what it is. You wouldn't have a free market even if you had a gold standard. Is my statement, and feel free to tell me.
Let me make two quick points, because we're over time, I know. One is that if gold goes to $10,000 an ounce, it's not that everything else stays the same, right? That's the dollar devaluing. I mean, gold's not going to go up 20 times against oil. It might go up 30% against oil. So first of all, it's a dollar story, not a gold story. Secondly, there was a great banking analyst who was writing in 1833 named William Gouge, and he said, you can't imagine the world not controlled by the banks, right? Everybody owes them money. They owe everyone money. They control the newspapers. They control the politicians. They control everything, right? And if you think about today, that's Goldman Sachs, right? They own everything, and you can't imagine a world without them. But then he says, we know that human institutions don't last forever. We don't know what it is. We know it can't persist. And 4 years later, the Panic of 1837 comes and wipes all the banks away. And that's what happened in our situation. I mean, the banks seem monolithically in control, and they are, but a panic will wipe them away. And the only question is, do we go down the fascism route, some strong man who takes control, or do we let free markets reemerge? And that's the big political question.
All right, that's all the time we have. Thank you to my panelists.
Thank you.
Thank you. And we are going to go straight into our next mining spotlight. And we have Roger Jackson, Executive Director of NQ Minerals, up next.
Okay, thank you, Danielle. I'd like to talk about our company, NQ Minerals. I have a disclaimer there, like everyone else. NQ Minerals is a NEX, London-listed company. We go by the code of NQMI. We have some advanced exploration and cash generative projects in North Queensland, but what I'm going to talk about today is the Hellyer tailings project in Tasmania, which will be completed in mid-May and will be fully funded. Hey, gents, you want to you want to talk about that outside? We have a good board. We're trading on the OTCQB, and we have some options over the nearby projects at Hellyer. But firstly, there we go. The fun you can have with the drone. Look, that project is our next venture in NQ Minerals. We've purchased the project. It's fully permitted with a life of mine revenues exceeding $1.3 billion. Its post-tax IRR is 130%. I'm reading this out because all these points are very valid. The post-tax NPV of $210 million. It's a very low-cost project, so 46% gross margin. We have free cash on an average over the 10 years of $34 million, and our debt will be paid back in 19 months. I said it was a low cash cost. On a gold equivalent, it is a polymetallic project, but on a gold equivalent, it works out at $529 per ounce. Our startup capex is only $20 million, and that's Aussie, not US. And as I said, the first phase is processing the tailings. That'll be 10 years, and then we step into some very, very high-grade VMS deposits. The building, as you saw, is a huge undercover, I guess, state-of-the-art now. It's been since '88. It's had a number of refurbishments, and it's a very good mill. It's about the size of a football pitch, so it's quite big. We have a railway line that runs directly from our mill into the Port of Burnie, and the Port of Burnie has concentrate loading facilities into 45,000-tonne ships that we can export our concentrates direct to wherever we like. We're going to be producing 3 concentrates, a lead-silver concentrate, zinc, gold-silver, and a gold-silver pyrite. Tasmania has plenty of skilled available workforce. And we have a very short start-up period. We're anticipating to get this running in first quarter 2018. And we're going to move up from the next listing up to, excuse me, the London Stock Exchange. We're going to spend the rest of this year getting Hellyer into production. We're going to be drilling out some nearby deposits, and we're going to process some high-grade stockpiles that we've got of silver up in North Queensland. For those that don't know where Tasmania is, it hangs on the bottom of Australia. It's a very good place to work. Stock price is